So there are a lot of ways to define debt to income, which of course is also defined by DTI in the mortgage industry. But is there a magic DTI number that borrowers should aim for, or does it just vary by the loan type?
Yes and yes. We use a lot of initials, acronyms, when we talk about stuff. But debt to income is super important, and the there is, depending on the type of loan, there is a magic formula, and we'll kind of get into that.
I love it. With the Loan Doctor podcast, Richard Brandt, I'm Giselle Andres, and welcome to our waiting room. So what exactly is debt to income anyway, and that ratio that people talk about, and why does it matter so much when you're doing mortgage lending?
Well, debt to income is super important. We've talked about it on previous podcasts about cash flow, right? And debt to income is how a bank measures your cash flow. How much money do you have going in versus how much money do you have going out? And when the bank is determining that debt to income is really your monthly obligations, right? And we'll kind of get into the specifics about that, but the monthly obligations divided by your income. Now that comes with a couple caveats because the monthly obligations that we're talking about are your principal and interest payment on the house that you might be buying. If you're buying something that you're moving into, it's going to be the property taxes, the insurance divided by 12, and it's going to be the homeowner's insurance. Then it's also your credit liabilities. There's actually two types of debt to income formula. There's a housing expense, which is the things I just mentioned. And then there's a total expense, which includes the housing plus your credit cards, student loans, auto loans, any other recurring monthly liability that you might have. But it doesn't include things like your utility bill, your insurance, your auto insurance, that kind of stuff.
Okay, so I also know that there are two types of DTI, right?
Yeah.
There's the front end and the back end.
Right. Front end is the housing expense. So when somebody says the front end ratio, what they're really talking about is your housing expense income. Again, that's principal, interest, insurance, mortgage insurance if you have it, property taxes, and then your HOA.
Mm-hmm.
Right, divided by whatever your qualifying monthly income is. And that's a key term too, because sometimes people make money, but all the money they make isn't necessarily what the bank is using to qualify. So it's based on their qualifying income, and sometimes that could be a little bit different than what their take home is or stuff like that, but we can talk about that too.
You said that's the front end, but what's the back end then?
So the back end is your housing expenses plus your other monthly obligations, student loans, credit cards, car loans, recurring monthly debt that is not, your auto insurance, that is not your utility bill, cable bill, phone bill, that kind of thing.
What is more important to get the approval from the bank?
They're actually both important. So, and depending on the type of loan, they have some of those numbers mean more than another. Like sometimes the front end is the most important number, sometimes the back end. So it depends a little bit on the loan product, and it depends on their overall financial picture, which one ends up being more important. Most of the time, it's total DTI though, total debt to income.
This question might be bouncing off of the last one because it says, why do two different borrowers with the same exact income sometimes qualify for very different loan amounts?
That's actually a great question, and that goes back to their other debt. So if you have
For easy numbers, let's say they make 100.
right. Well,
That's an easy number
let's
to
say
calculate.
let's say they make 10,000 a month, right? Whatever. It's just a round number, 10,000 a month. If they make $10,000 a month, and one guy has a car payment that's $300, and one guy has a car payment that's $1,800, well, the guy with the $1,800 car payment is going to have a higher total debt than the person with the $300 car payment, and therefore the guy with the $300 car payment, everything else being equal, would be able to afford a little bit more home because he's got a $1,600 difference in monthly car payment in that scenario.
Right.
I know when you talk numbers, it can get really, really confusing. But the fact is if one person has, if they have two people have the same amount of income and one person has more debt, then they're not going to have the same buying power.
Now, how does DTI, and again, that's debt to income
Mhm.
ratio, how does that affect the interest rate, the approval strength, and the options for loan programs? Let's
Wow,
start
there's
with how does that affect the interest
there's
rate?
a lot to unpack there. So most of the time, the debt to income doesn't impact the interest rates. There are some programs that you can't qualify for that have rate based incentives that you might not qualify for if your DTI, debt to income, isn't below a certain number. So you might qualify for the loan, but you might not qualify for that particular incentive. So it could affect the rate in that regard. And then as you get into some of the bigger loans, jumbo mortgages, um, they also qualifying. They also have different rate structures for different debt to income levels.
So that's as far as the interest rate. How about approval strength? Are some debt to income like automatically the bank says yes or automatically the bank says no?
Yeah, it's with everything. The way I've said this to many people is your financial puzzle to a certain extent is like a GPA, right? If you think about high school and stuff like that, you're graded on these four subjects that we've talked about before: credit, capital, collateral, and cash flow. Cash flow is really what we're talking about now. But what happens is that cash flow number, that debt to income matters. It's impacted by the other three factors because if we're talking about GPA, if you have bad credit, debt to income makes a difference. If you have good credit, debt to income is less important. Not that you can't be over a certain number, but if you have higher credit, you could probably qualify for a higher monthly payment because you could stretch that debt to income limit,
Mhm.
whereas somebody with a lower credit score wouldn't be able to do that.
And is there like a standard rate? Like, is it 3 to 1? They say, let's say your mortgage payment was going to be, I don't know, $3,000. Does that mean you should be bringing in at least $9,000 a month?
So I would say this. I think everybody's number. It's funny because of the way that these numbers have gone. They're a lot different than they were 10 or 15, 20 years ago. The rule of thumb that I start out with is what does the person who I'm talking to, what does the borrower think they can afford, right? That now they might not qualify for that. That's a different story that I have to go through. But I usually start at that point, and for most people, what ends up happening is their number is actually less than the number that they would qualify for a lot of people.
Oh, I would have thought it was different. I would have thought it was more.
Yeah, most people tend to be a little bit more conservative than the bank. So there are some programs that allow you to go to. There's actually some programs that allow you to go higher, but if we're talking about the majority of programs, the majority of programs allow you to go to a total debt to income of 50%. So on a conventional loan. So if you have reasonably good credit, right, and your income, as long as your income, if your income was $6,000 a month, your total debts, if they were under 3,000, you would be pretty good. If your debts, your house payment plus your other monthly debts was less than three, and you made six, you'd be pretty good. With FHA, you can go as high as 56% of your debt. So FHA really lets you stretch it, but you have to be careful because with an FHA, that front end housing expense also makes a difference. You can't have let's say you had no debt, right? So then your house payment, you have that scenario that we were talking about 2 seconds ago, right? I make $6,000 a year. I want to do an FHA loan,
6,000 a year.
six
You
thousand a month, 6,000 a
okay?
month.
That would be tough to get
Right.
approved.
Sure would. I make 6,000 a month. I want to do an FHA loan, and the monthly payment with taxes, insurance, HOA, and the mortgage insurance is 3,000 a month. And I have no other debts. That's 50%, right? You can go to 56 on the total, but you can only go typically to 45 on the front. So that would be too much of a payment if you were doing FHA.
Now I know the bank when they ask you about car loans. When is this car loan going to be completed? Because if you only have 3 or 4 payments, it's not a big deal. It's not like 30 or 40 more payments,
Oh,
right?
yeah, yeah.
Why is it that the bank doesn't consider how much income somebody is making today? They need the last 2 years. Why?
Oh, that you know what? That's another really, really good question. I think that what happens is the bank is trying to predict what your future income is, right? And really, the I think the key word is stable, future stable income. And the best way to figure out what somebody's stable income is going to be in the future is to sort of look at the past, right? So somebody who let's say somebody who got a brand new job, right? Or actually, I'll use this just because it happens like a nurse, right? Let's say you have a nurse that for the last 2 years, she has variable income and she worked on average 30 hours a week, right? And now she's got this new job, and but her time is still variable, but she decided that she wanted to work more because she's buying a house, and now she's working 40 hours. We can't use the 40 hours if she just started because her history says that she really only works about 30. And there's no guarantee that once she's closes on the house, she's going to keep working the 40 hours. She could go back to 30. So that's why they use the history to better determine what's going to happen in the future.
That's fair. That's fair. So, what does stable and predictable income, because that's kind of where you're at,
Yeah.
actually mean from the underwriter's perspective?
Yes, stable income is sort of that previous pattern, right? What's been the pattern of income that I've earned over time, and there is a difference between somebody who had, let's say, a part-time job, and then gets a brand new full-time job, right? Boom, I was part-time, now I got a full-time job. That person, we don't have to average their income over 2 years because they really had a change of circumstance, right? Their job specifically changed and now they're in a role that's full-time and measurable. When somebody is paid on a variable schedule, meaning their hours are flexible, they're not fixed and all that, they're maybe not paid for pay time off and things like that, the only way to really calculate their income is to look at the past, to see what they've done before, because what they've done before can be reasonably relied on for what they're going to do in the future. Sometimes I had this happen to me just the other day. I was speaking to a guy who's got 2 jobs, but he's only had 2 jobs for like 8 weeks. So he doesn't have a history of having 2 jobs. If he had it for 2 years, now you can call it stable. Having it for 8 weeks, his income exists. We know that it's there, but it doesn't meet that standard of stable.
And how do lenders treat, now that you said this gentleman with 8 weeks, salary versus hourly versus commission versus bonus structures differently? Because
There's a
I've
lot
gotten paid
there.
all 4 ways,
Yeah.
and I know even as an employee, I have to agree that each one of those numbers were different.
When I answer this question, one of the things they're going to do is I'm going to say something that kind of sets us apart, and I'll explain why kind of when I answer. But so salary is somebody who has a fixed income. It doesn't, they typically get paid time off. They make the same amount every week
That's
after
your
week.
safest bet for the bank.
Yeah, and so that income is considered stable, like basically right away. Hourly, right, is less predictable. Because it's less predictable and we're not sure if there's a minimum number of hours that you work, we could use that minimum, right? But if in the absence of some type of minimum from your employer, hourly is really about, well, what have you done in the past? So if we're going to talk about stable with somebody who's hourly, we have to look at a 2-year history to see what they've done to know what part of their hourly income is stable, because the history will tell us.
And commission?
And okay. Then you've got commission and bonus. Commission is fun. So bonus income you can typically count, but you have to receive bonus income for 2 years. The other thing that happens with bonus income is if you go from one job to another, right? And you've only been at the new job less than a year and you haven't received any bonus, you can't count the bonus income from the previous job. And this is that part that I was going to say that kind of separates us. Commission income, if I made commission at one job, I got another job in the same type of line of work, and I also make commission income, I can count the commission income from both jobs. What's the difference? Why can I count the commission income, but I can't count the bonus? Right? Commission income is based on something, an activity you do that you control. Bonus income is based on an activity that's often beyond your control, right? If the company does well, you get a bonus, not necessarily you. One of the things that sets us apart, because a lot of times we will have an employer pay a bonus when it's actually calculated like a commission.
Yeah, I think I told you that was something that happened to me. I was a contractual employee.
Right.
And if my company hit certain numbers, I was given a bonus.
That's a bonus, right?
For those numbers.
Correct.
But when I went to get a mortgage, they said, well, we can't count this number.
Right.
And I said, but if you look at my paycheck, you'll see I got it every 3 months.
Right.
And it was there. I mean, if you give me 2-year history, I'll give you the 24 pay stubs. It says it there, right? Every third month I would get a bonus. But they said we can't count it because we can't guarantee that this number is going to continue.
I would say that was a lender who made a financial mistake based on the guidelines. One of the things that happens with most loans is most loans that exist, are what we call conforming. Conforming means that they're underwritten to the guidelines of the secondary market, and the secondary market could be Fannie Mae, Freddie Mac, or Ginnie Mae, depending if it's a government loan. And so, if in this particular situation, we're kind of going by the Fannie Mae rule or the Freddie Mac rule, but they'll count bonus income if you've made it for 2 years. The lender that you might have talked to might have had an overlay that said they can't do that, but the secondary market could, and you should have been able to get a loan. Now, commission income is a little bit different.
Well, I got a loan, but it was probably less than I qualified for.
Right. You probably showed less income, right?
Yeah,
exactly.
yeah. So I guess there's different ways of determining that debt to income when it comes to commission and bonus.
There's different ways of determining that, and you definitely want to go to, when you're buying a house, right? You really want to show as much income as possible, right? Especially if you're a W-2 employee. Mm-hmm. And so not every lender is gonna look at that. And so that thing that I said that where we separate, like not every lender is gonna go to the employer and say, wait a second, I know it says bonus on his pay stub. How does he earn it? Right? What's the reason? Is it a bonus because he makes a sale and he gets a bonus, or is it a bonus because the company did well? And if it's on his back, then it doesn't matter that you internally, HR calls it a bonus. We would call it a commission. And that makes a difference. I've literally saved not hundreds. I've literally saved many deals because I took the time to figure out exactly how the person got paid, whereas the other lenders that he was with didn't.
Yeah, I've seen you make extra phone calls and go all the way to corporate to make sure that they understand exactly what that borrower is trying to get done. Now, why do lenders average income instead of using the best or most recent year? So if somebody for the last 6 months has been using the number you said around $10,000 a month,
right?
But they made, let's say, $5,000 or $6,000, the other 18. Why is it that you can't just use the last 6 months where I was doing really great?
Again, that's in lending, it's funny because they throw out a word that changes the entire definition.
The word average.
Well, not average. I was actually thinking the word stable, right? So they don't say income, they say stable income. So and then it's a matter of how you define stable. Is stable income I've been receiving for a month? Most people probably wouldn't say that's stable. So adding that stable word and then defining that stable to say 2 years. So for people who have variable pay, not a fixed schedule, salary is different, but for people who have variable or commission and or bonus and they receive extra compensation, or people who are self-employed, we're going to take that history and we're going to average it over 2 years.
Now, for the average borrower, and that would be pretty much anybody who doesn't work in mortgages,
Yeah.
what is the biggest misunderstanding, if you will, that borrowers have about how much income they can use?
Yeah, it's funny. I think the biggest misconception is that borrowers want to use exactly how much they're making right now. The common misconception is, well, I've had a part-time job for 30 days. I don't understand why you can't use that income, right? Because what people do is they get a part-time job because they want to buy a house.
Mm-hmm.
And then so now that they've had it for a month, I've got this extra income. I should be able to qualify for more. Again, it's not stable. So how do you define stable? That's what lenders do. I think that's one of the misconceptions. And I think the biggest misconception in lending is how people is how people think about the four things that we talked about earlier. That they all are all connected. I've had a lot of people that have had, I'll give an example of just somebody who had $3 million in the bank. He's buying a $700,000 house. He's got $3 million in the bank. He could pay for the mortgage 4 times over, right, in cash,
Mm-hmm.
right? Why are we giving him a hard time about anything? And the fact is that you have those four things that we talked about: credit, cash flow, capital, and collateral. And if we go back to the high school metaphor, you have to be somewhat proficient in each subject. It doesn't matter. You can't borrow from one subject.
Well, if you have $3 million in the bank and you
Yeah.
owe $700,000,
Yeah.
right? The assumption is I could pay this off tomorrow.
What's the problem? Just give me a loan.
But we have people who have $3 million in the bank with really bad credit
I mean,
who just choose
yeah.
not to use the money they have in the bank.
Yeah. No,
They choose to leave it right there where it is.
Well, that's what I mean, right? Those other elements kind of matter.
Yeah, they
right?
don't pay their stuff.
No, and once you close, there's no guarantee that you have to keep $3 million in the bank. So yeah, so that's why those other elements matter.
Now, another acronym is the YTD, year to date.
Year to date.
So,
Gotcha.
how
Love
does
it.
year to date income factor into qualifying for a mortgage? So, we are right now, truth be told, whenever it is that you're watching this, day or night or whatever month, it is January currently. So, if you were to look at pretty much anybody's W-2 pay stub right now, it's kind of looking weak because we're just a few days into January, right? So, how does the year to date income factor into qualifying for a mortgage?
So when you're somebody who is variable, or even somebody who's salary, your pay, right, is typically, mostly with variable. I will preface that because this isn't universal, as most things in the mortgage business. When your pay is variable, you don't make the same exact amount every week after week after week. When that pay is variable, what happens is the bank uses one of three formulas to determine your stable income. It's your previous 2 years plus year to date, or the previous 1 year plus year to date, or year to date. And they use whatever number is lower.
So
Right?
right now is the
So-
hardest time to be filling
ri-
out those applications.
So right now, let's say right now you took a week off because to come back, right? You went away and you took a week off, and instead of working on January 1st, you didn't start working until January 7th,
Uh-huh.
right? Well, that means because we're in the month of January, you only got paid for 2 weeks or 3 weeks and not 4. And so then when we average your income, that's the lower number. And all of a sudden it does impact your qualifying. So especially at the beginning of the year, or if you took some time off, be aware of how that works, and make sure you go to somebody who can manage how to deal with that, because it's cut and dry. It can really impact somebody's buying power.
So if you're in a low income or first time borrower situation, is your best choice to look towards October or November to make an offer?
No, no, you don't have to change how you make an offer. You just have to sort of be aware of it, and make sure that you have a lender who can address it. You know, because there are things that sort of happen. You know, if you're on medical leave or something like that. But what tends to happen, what happens with a lot of hourly employees, is that, you know, in January they tend to take time off. And so if you're thinking about buying a house, we're already in January, so it's tough to give advice for next year.
Hmm.
But for those of you who might be watching this in November, what you want to do is, if you were thinking about taking time off and thinking about buying a house, maybe put off that time off until after you get the loan, and don't take time off in the beginning of the year where where it would bring down your average income.
Now, what's a real world example of someone who should qualify but doesn't because of that year to date income timing?
Oh, we've had stories. I had somebody who was a nurse. She made, as a nurse, she made, I think, $150,000 in the previous 2 years, and then it was, I think at the time she applied for the mortgage, it might have been even May, and she had taken 2 months off, or not 2 months, like 35 days. She took 35 days off. If she took 35 days off and worked 12 months, right? She would have made the 150, because she took 35 days off all the time, right? That she did that, but she would have had time to make up the difference. But because she took 35 days off, if you think about it, she was averaging about $12,000 a month, right? Well, because we were doing her loan in May, she was still making $12,000 a month, but she was making $12,000 a month for 4 months instead of five. So 12,000 times 5 is 60,000, right? 12,000 times 4 is 48,000. Now divide 48,000 by 5 months, and now her income is under 10,000 a month.
Wow.
And so the house that she wanted, she didn't qualify for. We actually had to have her wait a month and a half and increase, because she needed a little bit more income, not the full 12,000, but a little bit more. But we came up with a plan, but it was a real world example that definitely caused a problem.
Now, for self employed borrowers,
Yeah.
how do you manage that debt to income, that DTI, for somebody whose business relies on different numbers every month? Well, for the most part. I mean, yeah, I guess a self employed borrower still has a steady income to a certain degree, but you can't guarantee it.
Well, I think what happens with self-employed borrowers, you still have that 2 year look back, or you might have a 1 year look back, depending on how long they've been self-employed. Um, so especially when you're dealing with self-employed people, the indication of stable income, and I'm going to use that word until I drop. The indication of stable income really is, what did they do in the past? And then you might get like a profit and loss to make sure that their business hasn't taken a downturn,
Hmm.
you know. But you're really going to use those prior year tax returns to determine what their anticipated income should be in the future.
Because that's the trickiest loan to put together
Yeah, I
always,
mean,
right?
if you're using tax returns, the great thing about self-employed people, and we've mentioned this frequently, is that oftentimes what a self-employed person can afford in terms of a house payment is not accurately reflected on their income taxes according to the mortgage matrix.
Yeah, the criteria.
Right. And so we're able to use different ways to qualify to get them to the number that they can truly afford, right? Remember, I think we started the podcast by saying that one of the things I do is I ask people, what do you think you can afford?
Hmm.
Because people tend and it's funny because I will say this. When I ask people what they think they can afford, would you believe that it gives me insight into their credit score?
How?
All right. So let's say, so when I ask somebody what they can afford, right, and they're making $4,000 a month, right, and they tell me they can afford $2,500, I know their credit's bad. More than not. I know more than likely their credit's not great. Their credit's not great because they think they can afford $2,500 a month, and even a bank says you can't afford more than two.
Mm-hmm.
Right, 4,000, 50%, two, really, in a quick math kind of way, right? And that's not taking into account any other debts. But if I have a guy who makes $10,000 a month, and they come in and say, well, what kind of payment would you like? Well, we don't want to pay anything more than three. They've got great credit
Because they're always budgeting.
because they're always budgeting in a responsible way. Yeah.
Now, that philosophy is not always true because it's possible they don't have a car payment. It's possible that they've paid off their first property. It all's the ifs, right?
Well, I think what ends up happening is they might have other obligations like they could have like private school, right?
Mm-hmm.
Somebody might have private school, which is not a typical expense that we wouldn't count as a debt to income problem, but it's still an expense for the family, and so that might impact how much of a house. Yeah, but all I was kind of saying is that
There's a psychology there.
there's a psychology there, and it's usually pretty right. It's not 100%. But if I can kind of get an insight into somebody's picture 90% of the time, I'm a step ahead.
I would give them the advice of just lowering the number, except you're going to check their credit score anyway, so it doesn't matter.
Well, it's so when I have the great thing about this approach of saying, well, tell me what you think you can afford, and then I'll tell you what the numbers are that hits where that falls, right? Tell me what you think you can afford. When I have to have the conversation with somebody that gives me a number that's more than what the bank says they can afford, right? That really gives me an opportunity to set them up for success, because I'm not going in there telling them they can't afford this or they can't do this. What I'm doing is let's talk about how we got this number, and why is this the number, and what are some of the things that you might not be thinking about, and it helps me put them in perspective and kind of line up the reality with their situation so that I'm setting them up for success in the future.
So you were talking about their taxes versus what they feel that they can afford because they know how
Self-employed
much
people.
they have, right?
Sure.
As far as self-employed borrowers.
Yeah.
So how do tax write-offs impact usable income, and what surprises people the most about it?
Okay. So I could tell you that the biggest surprise that self-employed people often have is that their gross income is not their income. Or I don't want to say gross income. That what happens with a lot of times with self-employed people is they equate gross revenue with income. So gross revenue is how much did a business make, right? But the business had obligations to pay in order to make that money,
Mm-hmm.
right? Those obligations had a cost,
Mm-hmm.
right? So really what happens is you take your gross revenue minus your obligations, and that's your income. And most people, when they first start talking to a mortgage person about how much money they make, they're always talking about their gross revenue, and they're inferring that revenue and income mean the same thing, and they don't.
That makes perfect sense. I guess that's the biggest mistake that self-employed borrowers make before applying for a mortgage, is assuming that that big number is the one they're going to approach the mortgage lender with.
Yeah, well, in fairness, because as I was answering the question, I was thinking about a tax return. The tax return actually says gross income, and or actually, you know what? I'm saying that it does. I could be wrong. Somebody might want to look that up just to make sure. but but yeah, that's the biggest thing is that people say, this is how much did you make last year, and they tell me the total revenue that the business generated, but they don't talk about the expenses that it took to get that revenue. And if you're going to make, if we're going to kind of make it simple, right? If you're going to have a house payment, right, then we need to know what was left from the business to know what you can afford for the house, right? So if your business made $1 million, but you don't have anything left because you spent $1 million, well, then how are you going to make the payment for the house?
Right.
And then it becomes, okay, now are we going to does the tax return actually reflect how much you actually spent or not? Sometimes that could be a little different.
Now, what can someone do 6 to 12 months ahead of buying a home
Love it.
to improve their debt to income ratio?
Love it. I think somebody 6 months ahead of time can do a lot.
Yeah, 6 to 12.
6 to 12. Yeah. One of the things that's one of my favorite categories of borrowers are people who make buying a house a priority and but aren't necessarily there today, right? And so what we get to do is say, where do you want to be in 12 months? And now let's look at where we're at and where we want to be. And now let's figure out what are the steps that we need to do over the next 6 to 12 months to get to that point. And it's a tremendous reward when we take somebody and we help them. For us, it's a reward. Like it's like watching a kid. But we work together with a plan. They execute the plan, and then 6 months or 12 months later, it turns into them moving into their new home. It's awesome.
So let's wrap it up with this last question, which I think is the simplest one of all. If somebody is worried about that, their debt to income, because they know you're going to check,
Yeah.
what is the immediate or the smartest first step?
The smartest first step is really to talk to a lender, hopefully me, but talk to a lender and give them the pieces of your financial puzzle. Most people don't realize that lending is all about you, not about, like, people call up and ask for rates and all that kind of stuff.
Mhm.
And it's really hard when somebody calls me and asks me for a rate. I can't give you a rate in any responsible way without knowing the pieces to your financial puzzle.
Yeah, like I remember having people call up and they say, I'll pay off my car. And that might actually not be the best deal. Hold on, hold on. Before you invest all this money in paying off your car, that might not be where your money should go. Maybe it'll be a little bit to a credit card. Maybe it'll be a little bit to the principal of the house. Who knows? Just hold on a second. Let's figure out.
It's the best people take a really comprehensive approach. Like a good financial planner is not going to tell you just to buy this or buy that without knowing your whole picture and your
Mhm.
risk tolerance. The good loan officer is going to make sure that he understands your whole financial picture, and then offers sort of the best guidance, and then you guys come up with a plan together.
Well, so these are the little hacks and tricks to debt to income ratio.
Yeah.
And we heard it right from the loan doctor's mouth. You committed yourself to all of it.
Yeah.
And again, it's Richard Brandt, the Brandt Lending Team, the Loan Doctor podcast. And as always, thank you for being in our waiting room.